Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, July 18th, just before the close. Week of chop again, and I've mentioned that for the last couple of weeks. But what I've been noticing is the pitch on opinions for the market is starting to get overheated. Many people thinking the market has quite a ways to run from here. Another group thinking the market is, edging towards a cliff and there's going to be headaches. You know how we play it here. We're going to let the market dictate risk levels. We'll adjust, we'll react. But I did want to mention one thing, because the din has gotten fairly loud in terms of negativity in the market, and it shows up in some of the sentiment readings. The banks, if I was short or negative this market, and the banks came out midweek, led by JPM and Wells Fargo and State Street, and gave you good earnings numbers and sold off like they did. State Street was down 4 or 5%. Wells Fargo pre-market down 3%. Even JP Morgan, who hit it out of the park, faded on price. If I was negative this market, that would start to get me excited. What would bother me if I was negative this market was the demand that came in for those securities. You got a little bit of a crease to put some downward pressure on this market, and there was just a ton of demand. Banks faded for half a day, started to rally, and rallied throughout today, and did so when there was a little bit of volatility. Why do I mention this? You know that markets can go up without the banks. Do so all the time. But rarely do markets really fall apart without the banks falling apart. I'm not talking about volatility. We always talk about this. Do not compare or confuse volatility with risk. Volatility is something we can't avoid. It's built into the markets. By the way, it's how we make money. It's how we make money for you. Volatility allows us entry points. I want to take you back to 2007. And the reason I say that is we are in mid-July heading into August. It's my favorite time of year for one spot in the country, Saratoga Springs. I've been going to Saratoga Springs for 25 years. I'm a big horse racing fan. It's a beautiful town. You've heard me say before, I think it's the most beautiful town in the country for 8 weeks a year. I can't take the winters there, but I could take all summer there. August of 2007, my wife and I go to the Alabama. That's a big 3-year-old fillies race every year. We're heading up, going across the wonderful bridge, Mohawk River Bridge there, and the banks are just falling apart. They've been creasing downwards for a month, but they're really falling apart on this particularly Thursday or Friday. And technology then wasn't like it is today. And I'm driving up, and I have Bloomberg on the radio, and banks are down another 4%. My phone's ringing, and I don't have backup batteries for my laptop, so my poor wife has to drop me off at the Saratoga Springs Public Library at 2 o'clock, because we can't get into our place yet. And I plug in, and there I am trading and adjusting portfolios from a public library. Why do I bring this up? Take a look at this slide. It's a performance overview of the KBW Bank Index. That's a NASDAQ bank index that tracks 24 large banks, thrifts in the country. And it's always been the benchmark for banks. In June, bank index peaked near 114 to 116. That was back in 2007. That's the era we're in. Sentiment started to turn. July, sharp decline began in mid-July as the credit crunch intensified. Fell all the way to 103, 105. August, when I was traveling north, going for a nice little vacation, we really get hit. Now the bank index is down really 20, 22% off its highs. things are starting to crack. That was a prelude 6-7 months before the S&P topped. 6-7 months before trouble really came around the corner. And I, to this day, lean on the banks as an indicator for risk, not for volatility, for risk. Even the Fed cut in September couldn't bail the banks out. So traders, investors were really sniffing out trouble well ahead of the S&P running into trouble. So I tend to lean on the banks. The banks traded very well this week. I like to say they traded dry. So in terms of that action, it gives me some confidence to stay pretty much fully invested. Sure, we have some cash in corners here and there, but net, our equity strategies are fully invested. I feel that volatility will always be around the corner, and we'll run into it before the summer's out. I guarantee that. But until I see the banks crack, I've got to lean into the risk question of a serious downturn around the corner. Will it come? Maybe it will. And if so, we'll adjust. But we don't want to get tied to an opinion either way that affects our positioning. It's important to fight your opinions. So, I hope that rant wasn't too long, trying to speak up against some of the extreme opinions today. We have the Moose right around the corner. Moose, what do you have for bonds?
Hi, it's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday morning around 9:30 on July 18th. This is the bond report. We're doing a little early this morning. This week, yields, if you looked at just the 10-year Treasury, you wouldn't think a heck of a lot went on. It's closing the week today right now around a 442. That's only a basis point higher than it started the week at a 441. 30-year bonds up about a nickel higher there at a 495. But a lot of volatility this week. Microcosm of last April talks about tariffs, the inflation that might come with tariffs, talk about Jay Powell. President wanted to replace Jay Powell. Bond markets do not like that. They want Fed independence. And so you saw that movement there. The real numbers, the CPI numbers and PPI numbers were pretty good relative to expectations. The expectations on CPI for the month were 0.3. It came in at 0.2 for the core and 0.3 on the headline. The PPI numbers, both core as well as headline, came in at 0 versus an expectation of 0.2. Very well behaved. However, the year-over-year numbers ticked up. And why? Because particularly in the case of CPI, you had numbers that were replacing lower numbers from 12 months ago. What does the market take away from this? The market takes away from this is that there is some inflation in the pipeline from tariffs. How long it stays, we don't know. We do think that tariffs tend to be, a finite step function, and then things start to settle down. So we haven't changed our mind that we think the Fed will cut rates later in the year, short-term rates. Muni yields this week, different story. You had a lot of supply. The July 1st, we've talked about it, the coupon payments and reinvestment periods, all that money was all spent. So this week, you basically ran into a heavy supply week without as much cash in the barrel, if you will, to pick it up. So yields rose, particularly on the long end. 30-year yields went from a 455 to a 475 on the AAA scale. 10-year bonds went from a 322 to a 333, up 11 ticks on the AAA scale. What we think is that the muni market is very cheap, particularly in the long end. And when you can get 5% yields on munis, that's a giveaway because it's almost a 8% taxable equivalent yield. This should settle down later in the year as some of the metrics get better. Supply should come down a little bit, and we still have some pretty good reinvestment periods ahead of us. The other things that we're looking for is a little more stability in the markets too. The volatility in treasuries, even though where you ended up isn't much from where you started. The moving around with 10 basis point range on the 10-year and a 15 basis point change on the 30-year bond, that volatility hurts the muni market because it doesn't allow the dealers to really hedge effectively. So what do? They cut prices. We hope everybody's enjoying the summer, and we'll see you next week.
Thank you, Moose. By the way, I may have to borrow that sweater sometime. You're always looking sharp. Enjoy the weekend.